Hi, just Spice everyone. Welcome to another episode of Spicy Takes. And today we have a special guest with us today. We have Jose here, the founder and CEO of VDEX. Hi, Jose. Thank you for joining today. How are you feeling?
G, G V Spice, GV Shark, GM
Yeah.
everyone. It's great to
Hey,
be here. I'm
I
so happy that you are having me, and I'm feeling great, and I hope you are too.
yeah,
sure are.
thank you.
Thanks for holding it down while I rolled in late here. Sorry about that, guys.
Yeah, so Jose, Ose, please meet Nathan is in charge of BD. Then our co-founder Matt is also here. I'm really happy to have everyone here. Thank you once more for joining. So today we are talking about a very interesting topic, leverage, and I feel like you are the best person for this topic. But before we get right into it, just give me a few seconds. Let me bop up the community to let them know that we have started.
Oh yeah, share it around, guys. Tell your friends, get them in. Spicy takes on the way. Come say what's up and listen to we got what we got to say here.
I'm telling all my friends right now, come on in. We're
Yeah,
having
there
a
you
we're
go.
having a
Yeah,
party here.
yeah.
Let's
Yeah.
go.
Okay. And that is okay. And that is done. So yes, if you're just joining us today, welcome. If you know there's anybody that needs to be here, just share the link with them. Let them join us right in. But in case you miss any part of this, don't worry. This is being recorded, so you can always go back to the recording and rewatch any parts you miss. But do make sure it's better to listen live than to listen to recording. So make sure you join us live and share with your friends. Let them join in. So we're just going to, get started. We have a special guest today. So hi Jose, please can you tell us a little bit about yourself and what
Oh, I think we might have lost Emma temporarily,
Yeah.
but go ahead, Jose.
did
All
I
right.
get cut off?
I think I'm coming through a little bit.
Can you hear me?
Yeah, but I think I got the gist. I'm gonna tell you a bit about myself. So I'll just go ahead. I'm Jose. I'm the founder and CEO of
Okay.
Virtual Labs and VDEX. VDEX is
Can you
a
guys hear me
perpetual
now?
trading platform. We yes, we got you. Is it? Am I coming through okay,
You're
everyone?
good, Jose. Yeah.
Awesome.
Yes.
Well, about VDEX, we're fully zero gas platform, sub millisecond finality, and we take Bitcoin margin. So we're all about the user experience. We get these benefits from a technology from our parent company called virtual rollups. Virtual rollups are basically like a Turing complete zero knowledge state channel. If for those of you familiar with the Lightning Network, it's the same Bitcoin protocol peer to peer channels and self verification,
Hi
and
guys.
that's
Can
the
you hear
technology
me?
we brought to
I don't know
bring
what
a
happened.
great perpetual exchange experience to Ethereum.
Yeah, sorry, you got kind of cut off a little bit in the middle of that, but TLDR for the end user, what's like the special trading experience they'll get through you guys?
I would say if I were to wrap it, it's a centralized exchange, but decentralized. So it's got all those nice features of no KYC, no VPN required. It's super fast, around 200 times faster than Hyperliquid. And we take Bitcoin margin, so that allows a lot of dynamic hedging, arbitrage opportunities. And overall, it's a lot more flexible.
Very
Okay,
nice.
nice. That's I like that. Sending some shots at Hyperliquid early, 200 times faster. That's the spicy line of the intro. Love to hear that.
That's why I'm here, right? Spicenet?
Yeah, exactly. Delivering the spice early. We love that. Yeah, I mean, I don't know if you know, Jose. I used to be building decks on Solana called PepperDex, and we had over 100 cool instruments for building and some new trading in the space, but unfortunate for us to live there. And we kind of ran into the issue and that every developer faces of like not knowing if you're going to be able to capture the users and liquidity if they move to a different chain. And that really was why we wanted to build Spicenet and how we evolved to be at the point it is now. But yeah, it's always nice to talk to a founder who's building trading infrastructure, because I used to be like a massive leverage trader myself. I don't have time these days to be watching the 15-minute chart and trading with leverage, but I definitely respect the game, and at times I miss those days because it was a lot of fun. And when I could focus in really well on it and be disciplined, I found I had like some pretty decent success leverage trading. Do you trade with leverage yourself?
It's really funny you say that. I also like to joke that I retired from the 15-minute charts into the 1 day or the 24-hour candles. So that's sort of where you have to be when you're a founder of a company. But I
Mhm.
built in my opinion, the best exchange to trade, but I can't trade on it. So that's a great irony. But I'm able to live vicariously through our users.
When you say you can't trade on it, you just mean because you don't have the time to do it.
Exactly. Yes. No
Yeah.
time, and I guess technically I'd be trading against myself, so that wouldn't really work, would it?
Yeah, I guess. So is the market making done in-house by you guys then?
Yeah, yeah. So it's a similar model to hyperliquidity provider with Hyperliquid. I'm already throwing shots, and it's sort of like that built-in algo trading market maker, where it's called the VMM, so virtual market maker, and users basically have the choice to either deposit and trade, or they can deposit into this passive sort of yield-bearing uh, market making fund, and returns there have been pretty good so far. But to allude back to one of the earlier things I was saying, it's Bitcoin margin, so you can actually put Bitcoin directly in there or Ethereum and get one-to-one par collateralized yield. So pretty cool compared to just stables.
Nice. Just out of curiosity, what's the Bitcoin yield like?
Well, so far it's been around 40%. So that's probably
Whew.
just because we're in early days. So definitely, don't quote it staying that high, but it's been pretty lucrative for me so far, as I am the largest liquidity provider.
Yeah, yeah,
That's what I mean by
nice.
I can't trade against myself.
Yeah,
Why do I
makes
that
sense.
Matt is currently eyeing that yield? Maybe maybe after this space is going to go peep and see whether I can throw in some funds in there.
Hmm.
So yes, guys. So sorry I rocked. I don't even know why. So I had to leave and rejoin. So sorry for that. I guess you've done your introduction. You've told us what you're building with VDEX from the bits I got in when I joined in. So let's just dive right into it. We are talking about leverage. Is it a capital efficiency tool or is it a Degen's dice? And I would really love for us to start from the foundation, the very foundation of what is leverage, because I know there are some persons here that maybe this is their first time of hearing leverage. And so it's always good to set the foundation and let's start from the grassroots. So, what is leverage? And in a very, very simple way, what do you define leverage in crypto today? So, yeah, Matt, yeah, you were
Yeah,
speaking.
okay. So yeah, leverage is essentially you're posting collateral and then you're using it to borrow more capital and take a position with that borrowed capital. So there's multiple reasons why people do this, and I think the question here is kind of the correct one, because a lot of people use this as like, oh, it's more volatility, which is kind of funny because in crypto, you're subject to a lot of volatility to begin with. Um, but the right way to use it is more so as a capital efficiency tool, in my opinion. because you don't want to move your whole portfolio into an account. Maybe you only want to move 1/10 of it in there, but you still want to be able to take your regular position sizing. If you're managing your stop losses and everything well, then you don't have to have your whole portfolio sitting in your leverage account to still be putting 10% of your portfolio value into something, and then putting that same position sizing into multiple things. So really, it should be used as a tool for capital efficiency, as well as like the ability to hedge out your positions by going short. And that's how most very smart traders use leverage, is to hedge out positions.
Um,
Yeah.
okay. So I think before we joined the live, I think Nathan had another idea about when we are talking about being a capital efficiency tool and a Degen dice. So him is on the other end that it's a Degen dice. Nathan, can you shed more light on that?
Well, leverage isn't something that I understand that well, and just kind of considering, general markets. I suppose in an ideal situation, leverage allows you to seize on an opportunity your powder otherwise wouldn't let you really capitalize on. But like as far as like providing raw efficiency or utility in markets, I'm not sure that that's something it actually does. But I'm really only speaking from a crypto perspective. I've never done much trading on leverage. It's not something that particularly appeals to me. So maybe I'm not seeing something about it.
Yeah, no, you know what? You're right. In crypto, it's largely used as like a degen way to gamble, basically. But in traditional finance, essentially, you're using leverage, like you said, to get access to opportunities that your powder wouldn't give you access to. So there's very reliable ways to invest your money that can give you a reliable 1% return. But if you have $100, then like, okay, a reliable 1% return. Oh, sweet, I can reliably get $1 over the next 2 months. Like, not very attractive, right? But it gives you access to lever up and turn that 1% into a larger gain. And as long as you're risk managing it properly, then it allows you to kind of get access to these strategies that require a lot of volume to be worthwhile, and not have to have as much beginning capital to access those things.
And that made me think of sorry, Amma. Made me think of James Wynn. I think that's something we definitely need to talk about today. I don't know if you guys have been following him on X.
I'm itching to talk about it.
Okay. What a story. All right, Amma, sorry.
Yeah. So Jose, what's your take on that in regards to leverage?
Yeah, I mean, I want to talk about what you guys were already saying with does leverage make positions more stable, or does that inject liquidity into markets? And I think a very interesting point in that is that in traditional finance, leverage does behave a little bit differently. That it is largely a mechanism used, or derivatives. I should say derivatives as a slight distinction to leverage, where a derivative is just a sort of a side bet on a actual asset itself. But with those spot assets versus derivatives, where a perpetual contract with leverage is a type of derivative, call options, put options, futures being other types of derivatives, is that the total value of all equities in the world is measured in trillions, right? So you have Nvidia, Apple around 3 trillion. Add up all the stocks and NASDAQ, DAX, and all of the stock markets in the world, it's around 1 trillion, or it's measured in the trillions, hundreds of trillions rather. And the total amount in derivatives is actually in quadrillions. So it's on the order of 1,000 times larger, the total value of all leverage assets and all derivatives. So it is largely a tool that is used to inject liquidity into markets and sometimes stabilize markets, and sometimes we can see that in some instances, like in 2007, leverage in fact made the markets less stable. So it's sort of a double-edged sword like that. But how do I feel of leverage in general? Well, of course, it is a Degen's dice type tool where you are able to double your or triple or any X your returns or losses. But on the other hand, it is also able to create dynamic hedge positions or arbitrage in ways that you wouldn't be able to with spot assets. So another thing I've been mentioning here is that VDEX is unique in the fact that we take Bitcoin margin. And that's important because you're able to deposit Bitcoin directly into VDEX, as you are also on some centralized exchanges, and then immediately go short. And because leveraged assets often have some sort of premium, if you're a short position right now in the markets, you'd actually be receiving a premium. So you're going to be receiving around 11% on that position annually. So you're able to take your spot position, but let's say you don't want to sell for taxes because you don't want to encourage spot losses and slippage, which can be pretty impactful to your overall profits. You can encounter slippage on leveraged exchanges, which is typically on the order of 0.1%, whereas on places like Coinbase and Binance, it can be closer to 1%. And that's it's going to allow you to retain more of your profit by using those advanced.
Yeah. So Jose, is that kind of what the liquidity provision vault is doing to generate that yield? Is it capturing perpetual funding rates? Is that like the main source of the income for it?
Yeah, it's a few things. So it's 100% sustainable. It is deriving from arbitraging the funding rates, as you said, and also trading fees and net liquidations.
Okay, got you. Yeah, so it pretty much like top to bottom, it's doing all of the levels of market making. Like handles liquidation, takes a small spread, much smaller than the ones on the centralized exchanges, and then also captures the funding rate.
Exactly. Yeah, except I don't know if it's making any money on the spread. It's literally like $1
Yeah.
on Bitcoin.
Well, that's good for the end user. So, you said
And that's who we
you said
serve.
something that was kind of interesting, and I used to kind of track this closer when I was building derivatives products. But do you have any idea of like the state right now of how much is in derivatives versus the spot market in crypto? I mean, I know it was significantly less than like that 1000x that it is in traditional finance, but I haven't tracked it for about a year now. Is there any? Do you have any idea of where it's at right now in our space?
Yes, it's between. You're right. It is significantly less than traditional fiat and equity markets, and that's because it's less mature. It's between that 10 and 100 mark if you include perps, which is the main form of derivatives in crypto, but also options. And there are, especially on Binance options, there are a significant amount of volume there, and it hovers between let's say actually closer between 10 and 50x.
Yeah, okay, cool. So I'm interested to hear what you think is like the differentiating factor that, I mean, you have to believe that eventually we'll get to like 1000x in derivatives markets the same way that traditional finance has. I'm sure that kind of guides your thesis for wanting to build in the sector even. What do you think we need to do to get there? Like, in what way does the market have to mature, and where are we now that's like stopping it from being that 1000x volume and capital in those markets?
Well, I think the very boring answer is that we need more time. Crypto is a very nascent industry, 17 years, really, I would say just 10 or 15 years of true crypto as an industry. And, equities have been around for hundreds of years. And so they've just had more time to develop more complicated mechanisms as well. Credit default swaps or even options are not very used in crypto or futures that do expire. But I would say the maybe slightly less boring answer, something that we can do ourselves to further the needle, and even something that VDEX and myself are doing on the frontier to increase the liquidity in crypto, is to build, well, first of all, decentralized platforms. That's a leg up we have over traditional equity markets, and specifically involving, I would say that decentralization maybe is not the end selling point. It is to some users, but what I would really say is it's security. Just yesterday we had a $500,000 Oracle exploit on Chainlink. In the past, we've had hundreds of millions of dollars of levels of exploit, and that's a level of that's an example of just one specific infrastructure that is not yet ready to sustain 1000x levels, quadrillions of volume in open interest in derivative contracts. And so there's a lot of infrastructure that simply needs to be improved. There's a lot more iterating that we need to do. And I would also say that we need to get comfortable with other types of derivative contracts. And so perpetuals are very popular, made so by platforms such as Hyperliquid, but options and getting the traditional players into options and even MicroStrategy, you could argue, is a derivative itself of Bitcoin. And so getting sort of other examples of contracts that users can be accustomed to. Well, we simply need more types of users, because crypto users have made it loud and clear that they prefer perpetuals, but there are other traditional traders that prefer other types, and so it's onboarding the masses, as it always is.
Yeah, for sure. The one thing I always felt was missing was like spread trades. You see so much of that being employed in traditional finance, and it just like doesn't exist in crypto. No one's doing it, and it's such a high volume thing because the volatility between the spread between two contracts on the same underlying asset is so small that you put so much capital into this. And I think that's really where a lot of that volume is coming from in traditional finance, is the ability to just dump loads and loads and loads of capital into a strategy that's low volatility. And we kind of don't have those strategies in crypto, or even the infrastructure to be executing those strategies in crypto.
Yeah. So when you were speaking, you mentioned different types of trading, and from all indicator, you are not really a big fan of spread trading. So I want us to throw more light into what narrative around leverage do you think are misleading or outright dangerous? Like what types that you feel like it's really really risky when it comes to trading in general?
I mean, I think the biggest misconception is that leverage is bad.
Mm.
I think that's like it kind of gets a bad reputation from people that don't really understand it, or a lot of the time it's because people didn't really understand it, found it attractive because they could take a $10,000 position with only $100 in their account. And then obviously that didn't go well because they didn't know how to manage risk. And then they come out with the notion of leverage is a scam and it's a way for you to take my money. And it's not the case. There's very responsible ways to use leverage and have it kind of guide your investment, make it even safer in some cases. And yeah, I think it is a really good thing. And like Jose said, it's just not mature enough in this space for people to see it as a good thing yet. Of course, there's people that use it in this space and use it the right way, and it is a good thing for those people. But the social consensus, I would say, on like crypto Twitter around leverage is more negative than it should be.
So you mentioned risks when it comes to leverage trading, which means risk management is very, very essential when it comes to leverage in general. Can you throw more light on, risk management that needs to be in place when it comes to leverage trading in general?
It's more up to the user, I think, but security is a huge thing. Like Jose said, like that would definitely reduce the risk a lot if we can harden that across the board. But I think, yeah, like having deeply liquid markets that are secure is the best thing that you could do as the actual provider of these leverage tools. And then from there, it's like you need the kind of well-versed trader to understand how to manage risk on their own.
Mm.
Like, I mean, the easiest answer would be like, yeah, use stop losses, get your calculator out, decide how much you're willing to lose, and then size up to an amount that allows you to set the stop loss that actually makes sense for your strategy. where like you should never be exiting a position because you didn't fund it enough. You should be exiting a position because it was invalidated. So you should never be basically risking to a stop loss or to a liquidation price that is still at a level where your thesis is valid. So if I'm trading Bitcoin and I basically am able to determine, oh, Bitcoin is still bullish as long as we stay above 100K, right? And then my stop loss is at like 103K, then I've screwed up from a risk management perspective, because if we get down to 103K, my thesis is still valid, my position is dead. And yeah, it kind of just takes a more mature market to understand and know how to apply the tools that we do have, like stop losses and size, correctly to keep their thesis alive.
And I'll speak as the founder of an exchange. We do
Yeah,
not want liquidations. This is a misconception that exchanges somehow benefit from liquidations. Not really. We actually want users to be safe and to be profitable and to manage their risk properly for the solvency and stability of the exchange and other users. So liquidations are not good for anyone. And that doesn't mean that leverage is bad. I mean, like you said, leverage is leverage. Leverage is not good. Leverage is not bad. Leverage is leverage, and you simply need to know how to manage risk. And yeah, just speaking about why are perpetuals and leverage a benefit? Why is this an argument for capital efficiency? Because the title of today's meeting was Degen's dice or capital efficiency, and I'm gonna attempt to make the capital efficiency argument, and you can let me know what you think. But one of those reasons why leverage is a genuine benefit to the markets as a whole, even to users and traders who do not use leverage directly, is because it allows a trader to be more directionally opinionated. So if, for example, you believe in the efficient market hypothesis, which kind of goes together with crypto like pudding and grasshoppers, so not sure if there's any believers in that in crypto, but let's say there is a fundamental price for Bitcoin, and let's say it's 110,000, or let's say it's 100,000. And the current price of Bitcoin is 104K right now, last time I checked. And that means that actually, in fact, Bitcoin is a little bit overbought. Well, if there are simply more shorts in the market right now, then, or simply more longs in the market right now, then that price is going to be kept inflated irrationally for a longer period of time. But with traders like James Nguyen, and we'll get into that story fully, but leveraged positions at large, that's going to allow users to be saying, hey, we don't exactly have the spot capital to compete with you, but we are able to express our opinion more pointedly in a larger, more meaningful way through leverage to bring down the price of the asset closer to what the fundamental price is. That's one way that leverage can help markets actually act more rationally and add liquidity to markets.
Yeah, Nathan, you brought up the James Nguyen situation. Can you keep us going down that path? I want to kind of unpack that here.
So there's a little controversy how he got the money. I heard some talk that he gained it through illicit means. I'm not sure how true that is. And I think his starting position was, James says he started at 8K. But when he came into the news, I think his position was about 4 million. Traded it up to, I think, 94. And then he's down to 25, up again. And now he's like negative 8 million. And something that I think is quite interesting. There's a lot of directions we can take this, but and this, I think this also has interesting theoretical implications for Michael Saylor. But anytime your position is publicly known, people will try to hunt you out. And it seems that I was hearing that James got hunted out. And on centralized exchanges, we've all heard the rumors that if you're large enough, they'll hunt you from the inside. And on chain, the circumstances, on-chain data is very, very public. So it's not like, like on a SEX, you're hidden from third parties, but there's always the incentive there for the exchange to get you on the SEX or on the DEX, anyone can see you and get you out. And I read a real interesting comment on this that basically was positing that the on-chain exchanges must pivot to ZK. So you can have publicly interactable positions, but privately positioned. And so that's where I'm going to stop there. I kind of want to see where you guys want to take this.
As a
Jose, you're nodding your head, so I'm gonna let you.
Yeah, I mean, as a ZK advocate, I obviously aligned with what you said. Even outside of VDEX, our parent company, Virtual Labs, are building, and we built the first zero knowledge state channel, and that's basically scalability and privacy together. And taking that to VDEX solves both of the problems that you mentioned. There's no one that can know the trade, no one can be hunted, and it's yet still 100% secure and anonymous at the same time.
Hey, Jose, if liquidations are bad for everyone, then why do trades get hunted?
When I say everyone, I will clarify that I mean the exchange and the trader. I see that there is now a way for other people to take on that direction and hunt that user. And there's always, I guess, what we say, bad actors, and that doesn't apply to that type of character.
Yeah, for sure. Could you explain for everyone, like, how does that bad actor profit off of driving the price into your liquidation?
Yeah, so in the example of Mr. Win here, who ran it up to 80 mil and down to -8, I believe, or around the figures. Well, he was hunted, and the shorts basically were able to profit off his liquidation and profit off also knowing specifically what his liquidation price was. So when there are orders on a spot market, you can tell that there are, for example, liquidity walls. There are basically barriers at certain price. So 92K is a famous one, 99K, or back in the day also 21K. So a lot of liquidity accumulates around these prices. And that means that if you're able to break these prices with sufficient volume, then you can get past and break through these points. But with perps, it's a bit different because there is so much liquidity in derivatives. There is effectively a liquidity wall at every price. So the mark price, which is the current price of the perpetual asset, by the virtual market maker and hyper liquidity provider and any algorithmic trading out there is going to be roughly actually an equal amount of liquidity in bids and in asks around the mark price. And so you don't have that same level of liquidity wall and that information. There's basically less asymmetry there in perps than there would be in spots. But if you're able to know a specific trader and what their liquidation price is and somehow gain information on that, then you know exactly at what price and how much liquidity you need, given, again, also the market maker's public order book and the open orders they have there, to cause a liquidation and calculate through a simulation, will that be profitable at what point, and how would you execute sort of that attack would probably be the best word, although some would even say exploit to be a bit more sinister.
I think of it as like the OG sandwich attack. It's like, somebody has to buy or sell, and then you create the same action right before they do, and then the reverse action right after, and you just capture the difference in price based on that action that that they were going to be forced to do.
That's another good way to think about it.
Yeah.
Okay. So guys, we've spent over 35 minutes. I've really learned a lot from this space, especially for me that is not really big on leverage. I am so scared of leverage trading. So I've really learned a lot from here, and I will try to experiment some few things here and there, but I'm going to take my risk management really, really serious. So, guys, if you're just joining us today, please know that this is Spicy Takes episode 7. So, if you do have any take on leverage, it being a capital efficiency tool or a Degen's dice, just drop them in the comments. We also want to hear from you. And also, if you do have any questions, drop them in the comments. If we can take them, we are going to be replying. The speakers are going to be in the comment sections replying after the space if we can take your questions. So drop your takes, drop your questions, and also you can still share the link for people to join in. They can also listen to the recording. And if you joined us late, we have Jose here, the founder of VDEX. Hi, thank you once more for joining us today. So let's wrap it up because we just have about less than 10 minutes. So I would really love to ask this question. Now, if you had to redesign, you've said that, leverage still needs more time to grow, especially in the crypto space. So if you had to, redesign leverage from the scratch for the next generation of users, what would you keep? What would you kill? And what would you completely rethink, especially with the recent happenings and all of that? So hi, Jose, of course, I'll be starting from you.
Well, I would be doing Amma exactly what I'm doing now, which is building VDEX, and
Wow.
we wanna create secure environments where traders feel comfortable putting the leverage they want on their positions. And so there's nothing fundamentally that I would change about the concept of leverage. I mean, one pet project that I want to explore soon is adding options onto VDEX. And so options have naturally their own sort of stop loss on there because it's a fixed amount you can lose. It's you're buying a contract and it's not perpetual, and then your profit is, unless of course you're writing options, in which case that would be having a undefined loss. But in general, there are more precise instruments for institutions to make directional bets. And so I think that's one thing that I'll want to add. But in general, there's nothing that needs to change about leverage itself. I mean, it's education that needs to change. It's Oracle prices that need to be secure. We can't have ridiculous liquidations like we had on Chainlink for $500,000 yesterday. And then it's also having privacy. So virtual rollups are private from day zero. We are built on zero knowledge state channels. So what happened to James Wynn on Hyperliquid can never happen to any trader ever on VDEX. That's another value add of our exchange. And I would just say that we continue also to build out real tokens with real value propositions as well. So Hype token, Bitcoin, Ethereum, there are some tokens out there that they themselves will be able to have high amounts of leverage and derivative volume on top of them. Another reason why we don't have 1000x like equities do now is because crypto is already so volatile, because a lot of the value in crypto is speculative already. So why add more leverage to that? There isn't enough liquidity in the world, and there isn't any market maker willing to take directional bets on, poop coin or Trump Biden kitty coin or whatever is the latest meta. There just aren't enough real approaches there to add leverage to. But for the real coins, the ones that are gonna stay, then we will be able to build out leverage on them as they approach their fundamental values and become a little bit less volatile.
Yeah, I think you pretty much nailed it there, and you kind of covered all the bases. It's like you need to bring ZK into the equation. That's a huge step. And then added instruments and better assets is what's gonna allow like the tech that all of us are building to be used. I think a lot of the assets just kind of need to cater to a broader audience. So tokenizing things, bringing things on chain, assets that people actually care about, rather than, the crypto assets that a very small portion of the world cares to hold and use, is definitely a key to that. And I see a question up here on screen about like the most effective way to use leverage. I mean, this is I would challenge somebody to do this if like you've never used leverage before and you want to know how it can be a useful tool, besides degenning, is like go out, take your asset like Ethereum and use it in an opportunity that takes away your ability to have it liquid, but grants you the ability to have yield. And then when you would have wanted to sell that Ethereum, hedge it out on a leveraged market. And you're even probably going to end up capturing a funding fee, because most of the time longs pay shorts. So, you're scared of getting trapped in staking and not being able to sell your asset. The next time you end up in that situation, use leverage to hedge it out and get paid yield on the long end and get paid yield on the short end by funding all the longs that people are taking. And if you can do that well, I mean, do your research on how to do this and not get screwed. But you'll be happy that leverage exists if you figure out how to do that.
And then also for us Americans, if you don't want to have that taxable event, shorting is also a great way to reduce your exposure in the short term.
Correct. Yeah.
So I'm still bringing up some more questions that I'm seeing in the chat. So somebody is asking, how does Spicenet's omnicomposability address the issue of liquidity in general?
Unifies it and distributes it. So it's really hard to grow liquidity everywhere in the space and have it be deep if you want it to be accessible everywhere. And this is a trade-off that pretty much everyone has to make is, I want to exist on 10 chains, and it's hard to, if you split up your liquidity amongst those 10 chains, then it becomes illiquid on every single one of those 10 chains. If you want to issue an asset and have it be deeply liquid everywhere, Spicenet's your guy. You build on one chain, you source the liquidity on that one chain, and then you make it accessible everywhere, and you have unified liquidity and infinite distribution through Spicenet. So it really solves like the scalability issue of being able to have assets that are deeply liquid and making them available to everyone.
Yeah, thank you guys. I'm just scanning through the comments. I'm seeing if there are more questions or takes. I think that is the most of it. We've spent close to 45 minutes here. So I guess we should be wrapping it up here. If you still have any takes you would like to share, please drop them in the comments. We'll be looking through the comments. The speakers too will be in the comments. And I'm sure, me personally, I've learned a whole lot. And I'm sure you guys too have learned a whole lot. So thank you guys for joining. Thank you, José, for being here. You were the perfect guest for this topic, and I'm really, really glad to have you as a guest here. I hope we get to host you some other time. And also, of course, thank you, Matt, for being here. Nathan, thank you for having a different take. I love that. And yes, for our audience that joined, thank you guys for joining. Know that this is Spicy Takes and we do this weekly. So see you guys next week on another episode. So thank you guys. Stay spicy.
Take care,
Thank you.
everyone. Thanks, Jose.
Thank you for having me.
Thank
Thank you for
Of course.
coming.
Thank you, Jose. Hope to do it again.